Welcome back to Shadow's Opening Bell, everyone. Four of the biggest names in technology reporting earnings after the close yesterday. Apple, Amazon, Google's parent company, Alphabet, and Facebook opening their books for Wall Street. And three of the four stocks, they're actually down this morning, which is why we see the broad market lower. For more on this, I want to bring in our next guest, Thomas Hayes. He's the chair of Great Hill Capital. Thomas, it is good to see you this morning. So I want to start with the one company of these big tech names that's actually in the green, and that's Alphabet. Take a look here. Google's parent company reporting earnings per share of $16.40, well above the estimate of $11.29. Revenue coming in $3 billion above estimates. The success of Google Cloud and the return of YouTube ad spend helping propel these results higher. What do these numbers signal to you about Alphabet and the strength right now in the ad business?
Yeah, well, Kristen, thanks for having me. I think the key story here is that these stocks were priced for perfection. And if you look at Google's current year earnings multiple, it's currently at 35 times, which is reasonable relative to its peers. Its forward multiple looking out is 27 times forward earnings, and it's going to grow earnings at 27%. So when you looked at the earnings results, Kristen, they were really great, obviously priced for perfection, but the results were great. So the EPS was up 22%, the revenues were up 14%, and as you touched on, the search, there was a real worry that search revenue was going to be down because you saw Microsoft's Bing was down and people were worried about YouTube advertising. They were worried about search advertising. And those fears did not come to pass. As a matter of fact, 6% up year on year. So that was really welcome news from the street. And I think the other positive surprise you saw with Google was the fact that they decided moving forward, they're going to break out the Google Cloud data. So what they're saying to the street is that our cloud business is now gaining traction against Amazon Web Services, against Azure, and we want to tell you about it because it's doing so well. So those are really the positive things. Number one, it came in with the lowest valuation. Mm-hmm. Number two, it had a great beat, and these are some positive things moving forward.
That's right. Valuations, obviously a big concern among these tech names right now in this market, which I think, to your point, is the reason that we see some of them pulling back. Apple is a prime example of a technology name pulling back today after its results. A bit of a familiar story there, declining iPhone sales as the company is trying to diversify itself into more of a services company. Earnings and revenue basically in line with expectations, but iPhone sales down more than 20% from last year. Services up about 16%. Do you give Apple a pass on this quarter, considering that the new 5G capable iPhone was not yet debuted?
Yeah, I think it's really a big deal that they delayed their launch because in China in particular, the iPhone sales fell 29%, but all the other product categories in China were actually up. So it wasn't an anti-Apple thing, it was just people were holding off those sales till this quarter to get the latest, greatest phone with 5G capability. So I think in some sense you do get a pass on that. Tim Cook alluded to the fact that the first 5 days of shipping data for the iPhone 12 in this quarter are looking very promising. He showed optimism about that. And the other thing that we have to keep in mind moving forward, though, is the record Mac sales and iPad sales were very strong, but that was largely a function of COVID and people having to work from home, study from home, et cetera. So they pulled forward a tremendous amount of those sales, and that'll be something to look at going forward. So we should see a huge increase in the iPhone sales, but at the same time, maybe the Mac and the iPad sales were pulled forward. So that'll be something to keep an eye on. But to your point, Kristen, about services, that was the key story, up 16.3% this quarter, 585 million subscribers, paying subscribers across all platforms, and some positive things going forward. But again, getting back to the multiples, again, it was trading at 35 times current year's earnings coming in. The last decade, it's traded at an average of about 20 times current year and 29.56 times next year. So again, for a company that's growing at 20% earnings growth next year to trade at 29 times earnings is a little bit higher than the S&P, which is going to grow at 24% and has a 20 times forward multiple on it. So I think people are just taking a little breather here, digesting it, and making sure that those iPhone 12 sales are going to be solid.
Interesting. I'm glad that you brought up the consumer in China. I'm just curious. I mean, does the Chinese consumer, in your mind, have buying power right now? Notably, it's really the only country that we do anticipate to grow this year that economists estimate will see GDP expansion. Does that mean that China might be the white knight here for Apple come this next quarter?
Yeah, I think there's tremendous pent-up demand. And if you keep in mind, they were about 2 months ahead of us in their recovery because they had their first epicenter peak in February, whereas we had our first epicenter peak in April. So as you're seeing with the consumer numbers turning positive in China for the last 2 months, positive GDP expectations for this year, being 2 months ahead in terms of the recovery, I think that's certainly going to go a long way to help Apple in terms of sales. The numbers, top and bottom line, were fantastic. It's just a question, how much is the market willing to pay? And is this sector potentially due for a short-term breather, a short-term rotation based on these multiples?
Okay, so let's talk some Amazon, the e-commerce company crushing analyst estimates. Maybe no surprise for our viewers, reporting earnings per share of $12.37. Get this, well above estimates of $7.41. Revenue soaring to more than $96 billion, up 37% from the same time a year ago. But the asterisk on those sales is the cost of shipping actually rose. We've seen costs rise during the pandemic. That cost the company $15 billion. The stock down on guidance, vague guidance, that is. Is there any real clear reason to you, Thomas, why the stock is down today, or is this another valuation play?
Yeah, I think it's a couple of things. Number one, they announced they're going to have $4 billion of COVID costs next quarter. So that's going to impact operating margins, which is a big deal. Certainly it's short term. You can look through it, but at the same time, it's a very big number. To your point about shipping costs, up 57% in this period. That was tremendous. But I think the real story was actually Amazon Web Services. So we saw Google getting very confident about their cloud services. Amazon Web Services actually performed in line with expectations on AWS. They did not crush it. Obviously the numbers were very good. They were up big, but they did not exceed expectations. So maybe the Googles and the Azures of the world are starting to take some share, and that becomes extremely important because Amazon Web Services, the profits subsidized the other businesses, the e-commerce and some of the other services. So if they slow down on Amazon Web Services, it's going to limit what they can do on e-commerce. So we have to keep a close eye on that. And that's also been the story. If there was ever an antitrust issue and they were broken up, how would the e-commerce survive if you didn't have the subsidization from the Amazon Web Service profits? So we'll keep an eye on that for Amazon. But again, let's take a look at the multiples. Over the past decade plus, it's traded at about 40 times current year earnings. It went into earnings trading at 99.7 times current year and 71 times forward on a 39% earnings growth rate. So again, it's just a little bit in terms of valuations, and I think this group probably wants to take a little bit of breather here in the short term.
Okay, Thomas, finally, we got to talk about Facebook reporting a beat on the top and the bottom lines. The leading indicator for ad revenue actually surpassing that is user growth, and that's where we're seeing Facebook struggle. The social media giant reporting a decline in users in the U.S. and Canada. Yeah. Ad sales were actually strong, but does the positive number that we saw in Alphabet when it comes to YouTube spend, what does that mean for Facebook, and what do you make of these results from Facebook?
Yeah, it was a big surprise to see the daily active users in the US and Canada drop from 198 to 196 million. That's the bad news. The good news is globally they have 2.74 billion monthly active users, and that number was up. The other headwind that we have to look at with Facebook moving forward, besides the regulatory headwind and potential issues with Section 230, the liability protection, is the iOS 14 operating system is going to limit targeting. It's going to protect data on the devices. So Facebook's knitting is the ability for advertisers to target the audience they want to deliver their message to. And Apple is effectively going to block that and say, you're not going to access the privacy data of our users. And that can have a dramatic impact, because if you can't target as well, you're not going to be willing to pay Facebook as much money because your conversions are going to be lower. So I think that's a headwind that analysts are looking at and starting to get a little bit concerned about. Obviously, the regulatory pressures. FTC is going to make an imminent decision whether they're going to be moving ahead on antitrust issues with Facebook. So there's really just a lot to look at. That's the downside. The upside, as you pointed to, net income was up 29%, sales were up 22%, and looking at their multiple, they've traded at an average of 28 times current year. They went into this trading at 35 times current and 27 times forward on 27% earnings growth. So, Kristen, I think when you look at the whole sector, the S&P 500 is trading at 20 times forward earnings. It's going to grow earnings next year at 24%. This group, on average, is trading at 39 times forward earnings on average, and it's going to grow earnings at 31%. So you're paying a 95% higher multiple for these companies on average for only 26% more earnings growth. So it's just something to keep an eye on. And the other thing that you want to keep in mind, Kristen, is that historically after elections, in the first 6 months after elections, cyclical stocks tend to outperform on a relative basis to infotech and technology stocks. So I think maybe investors are starting to get ahead of that, and they want to, as they're seeing growth come back into some of the cyclicals, as GDP grows and turns positive, they want to start to get some exposure after seeing that GDP print yesterday.
All right, Thomas, breaking it all down for us in a short amount of time. Thank you. That's Thomas Hayes, chair of Great Hill Capital.